Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our January monthly market update. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So we'll get started. First of all, I want to wish our clients and their families a very happy new year. And we're also proud to celebrate and announce Ann Fasoni's 18 years anniversary of serving our team and our amazing clients. Here she is at the center of attention, which is usual at one of our recent client events. This is our curbside event in December. So congratulations, Ann. We look forward to seeing many of you at our upcoming quarterly investment forum on Wednesday, January 29th. Where we'll unpack a lot of these items in a little bit more detail. So markets remain strong going into the latter part of January. Markets at or near all-time high. The S&P, this was the number as of last week, now sits at about 6,000. So as it relates to the bull market that we're in versus the median bull market, the current bull market that goes back to October of 22 is 26 months in length. The median or middle bull market going back to 1926 lasts 55 months. So again, this doesn't guarantee that we'll do this, but that does say that we're about halfway into the middle bull market going back to 1926. And as it relates to the current economic expansion that started in April 20th, we're about 57 months in on an average expansion of 61. So we're a little bit further along average expansion compared to where we are in the bull market. The most recent jobs number in December was a strong jobs number, up 256,000 and an unemployment rate at just over 4. What's interesting about this December jobs number, is you could categorize it in a good news, bad news kind of framing, because when this was announced a couple of Fridays ago, the markets immediately went down, the Dow going down almost 700 points, because the good news, bad news of a hot jobs market is a possible indication that the Fed will cut rates less or not at all in 2025. Following the jobs number, we had a CPI just a few days later that softened just a little bit, and the market liked this core inflation at 3.2. The S&P was up just about 2%. The Dow, which lost almost 700 points because of a hot jobs number, was up 700 points on a cooler than expected inflation number. So just an indication of kind of how jumpy markets are as it relates to this kind of data and what it means for the Fed, which we'll talk about next. This is a view of what the Fed's been doing. A lot of hikes in 22 and 23. The first Fed rate cut in 2024 in September, 50, and then a couple of 25 basis points cuts. After the CPI print, there is now about a 50-50 chance that the Fed will cut rates an additional 25 basis points twice by the end of the year. Again, that's subject to change based on changing economic conditions. But again, a 50-50 chance that we'll see at least 2 rate cuts now in 2025. So one of the conditions of the market today is that it's very top heavy. In fact, the Mag 7 stocks, which are all listed here below, drove over 50% of the return of the S&P 500 in 2024. Just gives you an indication, just going back to 2020, this same 7 stocks only accounted for 20% roughly of the S&P 500. So again, you have a very top-heavy index of 7 stocks, again, contributing over half of the return of the S&P 500, and those top 7 stocks contributing 30% to the overall index. And just some kind of past framing of that, over the last 30 years, the median or middle weighting of the top 7 stocks is 16. So we're about double where we are in terms of the median weighting of the top 7 stocks in the S&P 500. So as it relates to where we finished 2024, as it relates to the economy grew at 3.1, and it's expected to grow at 2.1 in 2025. So that's less robust growth anticipated, but it's still growth nonetheless. And as it relates to kind of some key economic indicators in terms of what would indicate that we're getting into a recessionary environment. Unemployment rate is barely above where you'd expect. Lending standards, small business optimism, and personal income are all fine. Industrial production is another kind of flashing red indication. So again, more indications than not that we're not headed into a recession, but still something that we're carefully following. Part of the recession possibility is the fact that 70% of our economy is consumer driven, and there's some signs of some weakness in the consumer. Average debt service ratio as of Q4 of 24 is 11%, significantly higher than it was just a few years ago. And delinquencies are picking up on things like auto and credit cards. So again, 70% of the economy consumer led, following the consumer and how they're doing. Are they employed? Where is debt service? All of those kind of things are worth paying attention to. And the reason we bring up recession is that the markets in their response to a first rate cut, which again happened in September of 2024, is very much dependent on whether you go into a recession or not. So over the first 12 months, again, which would be September to September, assuming you don't get a recession, stocks and bonds both perform really well. If you do get a recession within the 12-month period of time, that's still supportive of bonds, but not of stocks. Another area of concern that we continue to follow is debt. We're running 120% deficits now. We spent almost $1 trillion on just debt service alone, which is greater than defense. So again, this is worth keeping an eye on. Some movement in the long end of rates indicate a growing concern about this area. Again, it's something worth paying attention to. As it relates to the election, now that we're post-election, there's some indication, whether CEO of public companies, small business owners, CFOs, that there was some kind of pent-up investment pending election outcomes. So, for example, 62% of CEOs said that they were delaying key investments until after the election. So that's kind of a tailwind of the markets as you think about us being now in a post-election environment. And now that we have the results of the election, it's worth going back to times where the Republicans were in charge of House, Senate, and White House. It's only happened 10% of the time. When it happens, on average, you get a GDP that's up 3%, and you get an S&P that's up roughly 13. So again, even though the sample size is small because it's only 10% of the time, that would indicate good things on both the GDP side and the S&P 500. And as it relates to where we are in a mid-year cycle, going back to 1926, in the non-election years, so odd years, no midterm or presidential election, this is the average of stocks. So it tends to be a good year overall. So as we kind of think about headwinds and tailwinds, headwinds, which are kind of a friction against market growth, and tailwinds, which are supportive, let's kind of frame what those look like in 2025. So some headwinds, some things to be concerned about. Valuations are rich. You certainly can't say stocks are cheap, especially with the Max 7. The breadth is narrow, so a lot of the performance is coming from 7 mega cap technology stocks. Always a possibility of a recession and an inflation surprise, higher interest rates. The Fed backs off cutting rates, either less than the market was hoping or not at all. Geopolitical risk, debt levels remain high, and earnings at some point could disappoint. So some tailwinds, some things that are supportive of market performance continuing from here is that the Fed does continue to cut rates that they started cutting in September of 2024. We do get some kind of long anticipated market widening out of performance. The election risk is largely behind us. We had certain outcomes in an uncontested election. Geopolitical, to the extent that there's improvement, whether it's in the Middle East or Europe, could be a tailwind. Transformative AI and earnings continues to be supported. We did rebalance earlier this month, and we sent trade notes out regarding that. So none of this is a substitute to contact us directly about how all of these things apply to you specifically. So please reach out. We're here to serve you. And we hope to see many of you at our upcoming forum. We expect over 100 in attendance, and we'll be unpacking these items in more detail. So with that, we'll close. Again, thank you for the trust and confidence that you place in us. We look forward to seeing many of you next week at our forum. Until we see you again, be well and take care.